To the untrained eye, the commercial assembly lines at Boeing finally look like a corporate recovery story. Factories are buzzing, deliveries are moving, and the FAA recently approved a production ramp-up. But deep within the company's financial ledgers, an unpayable multi-billion-dollar time bomb is quietly ticking. For decades, Boeing was the crown jewel of American engineering. Today, it is an industrial giant trapped in a financial stranglehold. Following years of compounding factory caps, strict regulatory penalties, and billions of dollars in compensation payouts to frustrated airlines, Boeing's total debt load has ballooned past a staggering $100 billion. The company is burning through its remaining cash reserves at a rate that is completely unsustainable. How did an aerospace titan find itself on the brink of financial insolvency? To find the answer, we have to look past recent headline-grabbing mechanical failures and expose a massive, decades-long shift in corporate strategy. A strategy where Boeing stopped behaving like an elite engineering firm and started operating like a Wall Street cash machine, prioritizing short-term stock buybacks over actual aircraft safety and technical innovation. Today, we are opening the financial spreadsheets to expose the hidden macroeconomics behind Boeing's debt architecture. How do massive interest payments actively paralyze their ability to build a clean-sheet aircraft? And why is the United States government completely trapped by a manufacturer that is fundamentally too big to fail? Boeing's debt architecture is not an accident of bad luck. It is the logical outcome of financial engineering. Between 1997 and 2019, under intense pressure to maximize shareholder value, Boeing's executive leadership deployed a radical capital allocation strategy. Instead of reinvesting their massive commercial cash flows back into research and development for next-generation clean-sheet airframes, the company directed a staggering $61 billion towards share buybacks and dividend distributions. This multi-billion-dollar cash drain starved the engineering department at the exact moment Airbus was developing the highly efficient A320neo family. When Airbus began poaching Boeing's mainline customers, Boeing could no longer afford the estimated $15 billion required to design a brand new single-aisle aircraft from scratch. Their low-cost fix was to strap massive, ultra-efficient engines onto the 50-year-old structural frame of the 737, giving birth to the MAX, and initiating a chain reaction of corporate crises. When the technical shortcuts of the 737 MAX model inevitably resulted in global regulatory grounding orders, the financial fallout completely shattered Boeing's balance sheet structure. The 20-month grounding cost the firm an estimated $20 billion in direct expenses, legal settlements, and airline compensation packages. Concurrently, compounding production defects and strict FAA inspection regimes severely delayed the certification of the wide-body 777X, turning a primary revenue generator into a massive cash drain. Deprived of delivery payments, the vital 70% milestones collected only when an airline receives physical aircraft keys, Boeing was forced to issue massive corporate bonds to stay solvent. In less than 4 years, their total consolidated debt surged past $100 billion. With an ongoing quarterly cash burn rate frequently exceeding $4 billion, the company is trapped in a loop where they must borrow new capital just to pay off the compounding interest on their old debts. This massive debt architecture has pushed Boeing to the absolute edge of a financial cliff. Major global credit rating agencies, including S&P and Moody's, have downgraded Boeing's corporate bonds to the lowest possible tier of investment-grade status, just one fraction above junk bond status. A junk rating is an absolute catastrophe for an industrial manufacturing firm of this scale. If Boeing is downgraded to junk status, major institutional investors, pension funds, and university endowments are legally forbidden from holding their bonds. This would instantly cut Boeing off from standard, low-cost capital markets. To raise new cash, they would be forced to pay predatory interest rates to high-yield speculative lenders, adding billions in annual interest overhead to an operating budget that is already deeply in the red. Under normal free market capitalism, a company carrying this level of unpayable debt and operational strain would face restructuring or outright bankruptcy. But Boeing possesses an ultimate shield: the United States government. Boeing is an absolute natural monopoly within the American industrial base. It is the nation's largest single manufacturing exporter and acts as a primary contractor for the Department of Defense, building strategic refueling tankers, fighter jets, and rocket systems. Washington cannot allow Boeing to collapse without completely freezing the nation's commercial aviation infrastructure and compromising its military supply chains. This creates the ultimate moral hazard. Boeing is fundamentally too big to fail. As the manufacturer ramps its assembly lines back toward 47 jets per month, they aren't relying on pure market competitiveness to save them. They are relying on a sovereign safety net to keep their multi-billion-dollar debt trap from collapsing completely.